Land investing offers a hassle-free way for investors to take advantage of massive possible upside. With no tenants, minimal maintenance or management requirements, and less competition in the investment space, value appreciation really is the name of the game for land investors. Not to mention, land's subject to economic scarcity, which means they're just not making any more of it. But land investors, they need to think like real estate developers, because insufficient due diligence on the front end before you buy the land can lead to serious problems down the line. Hey everyone, it's Matt Marsh, founder of Martian Partners. Martian Partners is a development and national consulting firm that helps business owners and investors maximize their real estate and transform their businesses. Now, today we're going to talk about common land investing mistakes that people will make when buying land. If you haven't been able to tell, at Martian Partners, we're pretty bullish on land investing, not only for our own future real estate development projects, but as a buy and hold asset as well. But here's the thing, the kicker, land investing, it's not as simple as it looks. Oftentimes, there are dangers and pitfalls that aren't even evident on the surface of a piece of land. So my goal here today will be to help you avoid some of those common land investing mistakes that really can be the difference between wealth and expense in a future project or down the line. So let's dive right in. By the time dense development has already reached an area, it may be too late. The land's much more expensive. The land entitlement process is, it typically becomes a whole lot more challenging as a municipality grows. So anticipating the path of growth and getting ahead of changing human migration patterns, it's an important aspect of land investing and capturing that future value appreciation. Sometimes the path of growth is difficult to predict. Disruptive technologies, pandemics, think about the last couple of years. They might force people to live differently than they would have otherwise. But cities naturally undergo cycles. And as areas experience rapid growth, real estate prices rise, traffic increases, and the natural tendency for that growth is to begin pushing horizontally from urban cores. So, the path of growth then impacts land values, and if you fail to consider those fully, you'll likely leave money on the table. None of us have a magic 8-ball. Believe me, if I did, I'd own a whole lot more real estate than I actually do now. But I say that because anticipating a piece of land's highest and best use can be a challenge. If you buy land as an investment, well, ultimately, the goal is going to be to capitalize on the value appreciation because of it being more valuable in the future than it is today. But, what drives that property valuation and how do you quantify it? That's the ultimate question. Because what types of developers or investors are going to be interested in that property in 3, 5, or 10 years? Does the local government exert strong control over land use that could impact the future value of the property? They're all important questions to consider, and they all relate to a property's highest and best use, and ultimately what you can sell it for in the future. And your ability to quantify those factors will increase your likelihood of a successful land purchase. Now, before you buy a piece of land, there's a substantial amount of due diligence that's required to make sure that you're not buying something that really ends up being worthless in the future. Vacant land, it's subject to things like easements, covenants that actually restrict what, where, and how much can be built on a property. Additionally, a piece of land can suffer from environmental issues, even from adjacent properties. It doesn't even have to be something that happened on that land. Or it might sit in a watershed or a flood zone, both of which could greatly impact its value. Delineated wetlands, they'll impact the allowable buildable area on a property and will ultimately adversely affect its value. So these are simply a couple of a long list of items you'll need to consider before investing in a piece of land. But if you're interested, please reach out. You can ask us about our comprehensive land and site selection due diligence checklist to help on your next acquisition. Most real estate developers are primarily concerned with what a piece of land can yield them, how dense, and what types of allowed uses can they build. But things like municipal regulations, they'll govern much of what can be done on an individual property. Everything from zoning and stormwater regulations to property setbacks, allowable impervious surface requirements, right-of-way improvements, off-site improvements. All of these considerations usually rear themselves as dollar signs on a development pro forma. So as an investor, they're important to investigate if you ever think about selling down the line. A property's terrain and topography, they'll directly relate to the amount of grading and site work that a developer would need to contend with. Things like, access to utilities or a perk test, the composition of soils on a site. They're all considerations a developer would be concerned with. So ultimately, if your goal when investing in a piece of land is to ultimately sell it to a developer or develop the property yourself in the future, you need to consider how a developer will assess and value that property so you can buy it at the right price and properly market it. Now, failing to consider several exit opportunities before you buy a piece of land, it's likely the biggest mistake that I see land investors make. Land can be a highly speculative investment and often doesn't generate any positive cash flow unless you structure some sort of land lease agreement with, a farmer or a tenant or something. But the way in which you structure a land contract, it plays a large role in affording yourself the ability and the agility to pivot if you need to. But consider this for a second. A piece of entitled land is worth much more to a developer than raw land. So an early exit option could be to fully entitle a property with minimal capital investment and sell the land to a real estate developer without having to take on the full project cycle or building. So you'd capture some of the upside appreciation in the value of the property, but wouldn't actually have to go through the entire real estate development process, hedging a lot of your risk out of it. So before you buy a piece of land, make sure you've considered several exit strategies that you can employ at various stages of the investment cycle, under various macro and microeconomic conditions. If you couldn't tell, I love talking about land. We have a variety of resources available to better educate you on things like structuring land contracts, site selection, due diligence, land acquisition. Please check out the video description for more on this if you're interested. And please, if you enjoyed this video, hit the like button, subscribe to our channel. That will keep you up to date on content and help you through your real estate and real estate investing journeys. Thanks for watching.